Two, one. We are now live from the Tech Behind FinTech. I'm really excited today for my guest. I'm going to introduce him before I go on and do that. Once again, this is the Tech Behind FinTech. We really explore the technology behind the FinTech and financial services industry. My name is Nnamdi Osuagwu. I'm the host of the show. Today, I'm here with Ramadan Ameen. Really interesting background. Let me do the admin stuff and do the bio. Ramadan is the CEO of Stone Digital. He spent 8 years in the military as a military officer in construction and political military advisory at NATO. Spent 5 years at BlackRock. Also, he was in China running his own logistics business. Ramadan has an MBA from Columbia and an undergrad from Notre Dame, majoring in mechanical engineering and a minor in theology. Welcome to the show. Thank you very much for being a guest.
It's my pleasure to be here. Thank you for having me. Excellent.
So like always, with our show, we're going to talk about some news, by the way, within FinTech. So a lot of stuff going on, focusing on FinTech news. And then we're going to get into our topic of the day, which is the pros and cons of white labeling your FinTech startup. And later on, we'll get to what that all means for those who are new to that subject. So, like always, we start with the news. And please, guys, anytime you want to list you have a comment for us, please comment on YouTube or LinkedIn Live. And audience participation and interaction is really great, and it keeps things flowing. So the first FinTech news topic of the day we're only going to cover two today because I really want to dive into the topic and really dive into it. So the first news article of the day, Santander. Digital lenders have an unfair regulatory advantage post-pandemic. Santander's executive chairman, Ann Boulton, tells the Financial Times that banks cannot deploy their balance sheets to their full potential. Large tech companies are becoming lending platforms without having to comply with most banking regulation. I'm gonna get Ramadan's opinion on it, but before I do, I want to say one more thing. She cites that banks of banking international settlements, which suggest FinTech and big tech credit reached $795 billion globally last year.
Mm-hmm.
What are your thoughts?
You did tell me that you were gonna just throw some stuff at me. So
yeah, of course. That's why you have to keep you on your toes, man. We like that type of stuff.
Yeah. So assuming that everybody that's looking at this knows what that is, I'll just sort of do a base level of what that means. Generally speaking, you make money by lending money, right? And if you don't lend money, you don't make money. And so banks are consistently trying to do one of two things: have more money to lend, and then lend more. And one of the best things you can do is take people that are already putting their money with you and then lend them money. And that's how it's done. And what you do is you make interest on that, and you're able to grow the pot of money that you're lending. And so when we all no longer go to banks, that means that the only way someone can actually do some of their financial business or that they want to conduct, they can only do it online. And some platforms are just better at it than others. Equally importantly, the other way that you make money is you simply just sell products, right? Sell widgets, sell cars, sell houses, sell whatever. And you can also, instead of being a bank, you can work with a bank to allow your bank to provide a loan to the actual product. For example, everybody's buying an Apple product now. They know that you can basically just do a 1 year contract, and you just make monthly payments on it. Whether you do it or not, it's the same price, right? And so some people will just opt to do that. Now that's behind that, there's a bank that's paying the entire amount, and they're extending credit to Apple or to the person effectively buying that, and that then becomes a version of a loan. There's no bank that's addressing the issue with the actual seller of the product, and the relationship that sits with the bank in terms of being a regulatory or regulated entity might actually be the same. Now, in a lot of the regulated entity is already covered. Now, the interesting part here is that a lot of times, and I don't want to lose people here, but a lot of times, if you have a named company like Apple or a furniture store, they will use a non-branded bank, and a non-branded bank that doesn't actually really even have a physical presence. They're just simply a digital bank, and they're an address in Texas, and that address in Texas has and supports a number of other entities because they're just a virtual bank. And that virtual infrastructure and the setup they already have with people that are still buying things puts them in a better position than a Santander that may not have actually set up a relationship or white labeled capability with someone else. So like that's how I think that's the case. And I would say now that I explain what it is, I would say no duh, right? Those people that were ready for technology and ready to provide additional services are better. And that really it requires companies to really drill down on what they do, right? A bank doesn't do a brick and mortar building. A bank doesn't do physical entity here. They lend. And so if a banker begins to think about the supply chain of how they actually make their business work and how they get their clients, they should have begun thinking about ways they can access or an ability to get their lending product out there to as many people as possible.
So no, I mean, look, and thanks for that background, and I think that's great because I don't the general community outside is probably shielded from that type of information in terms of your explanation, which is that's why the explanation was so on point. But to what she said now, and looking at those white label banks and looking at especially a lot of technology vendors who are becoming digital banks, the regulatory standards from her point is different. Like from the banks, they have to have a certain amount in, where the new fintechs they don't. So she's in looking at it, saying it's an unfair advantage.
Yeah, well, yeah, I actually think, oftentimes I think people are lazy with their communication. So I don't want to write the author off a little bit.
Okay.
But regulation for like the industry also has some applications. So if these banks shut down their offices in certain states, then they would either be grandfathered in some cases. Some banks even use a different bank's framework, infrastructure, and approvals to be able to build their own capabilities. So I just don't know that that's really truly accurate.
Okay, interesting.
So like I think that what is an unfair advantage? But thinking in advance of the marketplace, understanding that the real thing here is that anybody, as I just mentioned before, banks make money through lending, and if they don't have people that'll buy or borrow, then they don't make money. And so if I have decided as a technology company to own the customer, then I have an advantage to any bank because I can provide services and I can provide solutions and I can throw interesting widgets at them to buy, and they'll want to buy them. And if I make it easy to buy them by connecting with the digital bank or licensing with a bank in a certain state that has different requirements than other states, then I have the ability to provide bank-like services without necessarily being a bank. Because I've got really good accounting, and because we let people purchase things with credit card or something like that, there's a way of addressing bank-like structures and bank-like services without being a bank. But again, if they're not a bank, then they don't effectively have to have and meet certain regulatory requirements.
That's an excellent point.
So then, is it a bank or is it not a bank? And if she's saying fintech companies have an unfair advantage because they're not really banks and they're providing bank-like services, I'd say, okay, great. But if you're a bank, you're a bank and you have regulations you got to follow. If you're not a bank and you do bank-like things, okay, fine, you do bank-like things. But oftentimes these bank regulations were in place to protect people. And there's like auditing, there's identification access, there's credit check. There's so many different ways that we now have the ability to give and offer things to people that perhaps maybe the old structure of a bank might not be as relevant today as it was yesterday. And that's
an excellent point. No, thank you for that background. I love it. And and to the audience, some of these things are actually, I love these types of conversations because they're learning lessons for me as well. So I like having it on video. We can always look back on it.
That is on video. This means that I might have misspoke a couple of times. Like, so I will just caveat that this is not my area of expertise. But conceptually, it's just about distribution and about a widget, and really being able to effectively collect fees and regulate it to ensure people are protected, right? Like that's structure that's not hard to talk about.
All good, and like the whole point is to our own interpretation of it, talking about it, and putting it out there for the audience to comment. So I like the next article, and I think this reason I chose this one is because it kind of starts to dive into, it's relevant to the topic of the day. Yeah. So on Tuesday, January 7th, African-American owned Citizen Bank selects CSI for core banking. The Nashville, Tennessee-based bank is implementing CSI's NewPoint, a fully integrated core banking solution. NewPoint is a cloud-based core banking solution that simplifies banking operation and provides the foundation for everything you do, from onboarding and servicing loans to processing and withdrawals. Just so everyone knows, a brief little history lesson: Citizen Bank launched back in 1904, founded by 3 African-American citizens, R.H. Boyd, Preston Taylor, J.C. Napier. The reason this is interesting to our topic is because I think it goes under the white label discussion, right? They're taking this technology, they're integrating into their own platform, and they're leveraging it. And we're gonna talk more about that, how it relates to fintech. What are your thoughts about that? I love the smile. That means something's coming. Yeah, anytime you see a smile like that, something's coming.
I don't think I heard the bulk of like the what did the bank do?
I'm sorry about that. So essentially what they're doing, they're going to integrate a CSI NewPoint. That's a company. They're going to integrate their core banking solution into Citizen. So this will provide them a cloud-based core banking solution. So it really falls back under the white labeling thing that we're talking about, in which you're taking this technology and integrating it into your own, but putting your own brand on top of it.
Yeah, right. So you're right. You sort of leading me down a certain path when you're talking about it. I don't. So my answer is like, that makes sense. If they didn't do that, I would question whether they had a really good strategist or were planning ahead. I think this is going to sound interesting, but there are people that are sick and dying because of COVID. And I was talking to somebody recently, and their comptroller passed away from COVID, and which is terrible. And their comptroller had been doing paychecks, accounting, payroll, all analog. And so having full visibility into the business in many cases required that he actually migrate the business from analog to digital. And that was supposed to happen by the end of this year. But because he passed away so suddenly, in 1 month, he integrated. He now has visibility into his business that he didn't have before. He has automation of paychecks. He didn't have that before. He has a reporting template and has hired people that that can now do the job, that are effectively on board with technology and are automating the company. Now, obviously, that's an example of like out of tragedy comes forth life. But in one sense of the word, very senior leaders of businesses, it's a framework I can think about. So think about it like this, right? When you work, you have knowledge of how a business works. You know how the business has been working. You don't know how the business could work. And when you have junior people in an organization, they come in and they understand how business actually can work because they have new information, but they don't know how this business works. There's this huge gap of knowledge. And as the junior people slowly replace the senior people, that knowledge that they had at best practices when they graduated from university or school is now something that can be applied to the rest of the business. And so in this case with my friend, the fact that the most senior person there, the team, passed away, put a junior person in the role who didn't know how to do it, and all they could do was leverage technology. Okay, and so this idea, it evolve or perish, is really a function of you need to find ways outside of COVID to bring junior people into a strategy session with senior people. They can really begin to integrate what consumers or effectively applications of how a business work with new knowledge that comes to the table. So in this case, you have a business that has a traditional function that has a problem of how do we begin lending or get access to a new user base, and we don't know how to do that. We have the licenses, we have the framework, we have the money, we understand our processes, but we don't know how to get our product out to the user in a cloud-like feature. So what they probably did was they had some junior person on the team, on their team, say, hey, there's a lot of other people that are doing this. I just looked at this bank out there that's going to provide these same services. How are they doing it? I've never heard of this bank. Who's heard of it? And it turns out this person who's 25 years old has, and says, well, we use this. I'm not even a banker of this system. And so what they do is say, okay, great. Well, then let's find out what they're using. And a little bit of research, you can find out what someone else is using, and you begin applying it. There will be a catch up because these banks that have been around much longer have more money. And these banks are either going to not make it, or they're going to start bringing in junior people that are between the age of 22 and 25 that have a better idea of what can be possible. And you match those people with the senior people, then there's an option. Or senior people retire because they're tired, and then junior people come in and go, I don't know how this is done, but we can do it this way.
Great points. Or acquisition. What we're seeing too is like partnerships that our incumbents are having with newly formed fintech shops, and they're buying it. And that's a whole other conversation then around certain, from having a background in larger banks. Now, when you partner with them, right, you're only as strong. Well, you're as weak as, what's the saying? You're only as strong as your weakest link. So now certain change management and process things need to happen on the startup side that they may not be used to. So that's a whole nother dive. Now we're going to transition into our topic of the day. So the topic of the day, I'm going to repeat it. Pros and cons of white labeling your fintech startup. So it's really the question to the audience. Look, you have two options right now. A lot of fintechs that you see, some have built it from scratch, meaning they have this great idea, this concept that could disrupt the marketplace. They have their team, they strategize it, they develop it, they architect it, and they develop it from scratch, build it all up. You have others that simply say, you know what, there are vendors out here that we can purchase their software and basically brand it with our own branding on top of it. And we have a market, we have a strategy, we have a good plan, and we're going to get it to our users. Pros and cons to both scenarios. So what we're here to discuss is, especially coming from a CEO's perspective of a fintech, what are some of the pros, what are some of the cons? So I think a good way to do this, we do one pro, one con, one pro, one con, and we just go back and forth like that. What are your thoughts?
Yeah, we can do that.
All right, excellent. So let's start with positive.
A pro.
Yes.
mean, listen, at the end of the day, if I think about, well, you know what, I'm going to propose a different framework.
Yes.
All you can do is, if you Google pros and cons of white labeling, you're going to get 16 different answers. And like, so what? So do that. Don't bring me in and have that list. So I'm not going to do that approach.
Excellent.
What I'll do instead is tell you a couple of things that I learned, which I sort of push back on all the time, right? Someone said to me once, Ramadan, you can change jobs, you can change cities, or you can change careers, or you can change locations, but you can't do both. And I would say, well, you know, yes, I can. And I've time and time again, there's obviously always exceptions to a rule, but but generally speaking, that's probably true. So when you think about your own business, you're either doing a business that already works and it's been working for a while and you have a new twist to it, or you actually have a revolutionizing the industry as a whole. And if you're going to do that, then you should probably use businesses or business concepts that are tried and true. Because if you try to actually revolutionize and then come up with new tech, you're now teaching people about a new system, a new way, and you're like using new tech that effectively you're now doing two things at once, just like moving to a new location and then moving into a new career. So in the same way, if you're going to revolutionize your business and you're doing something totally new, then I would encourage you to start with existing frameworks and existing tech, because you know it works. And there's a lot of risk in revolutionizing. You got to train your customers to think differently. You've got to train your users to think differently. You've got to convince an industry to try something out that's new and different. And the way you do that is you try to use systems that already work, so that you're not actually risking the system working and also the idea that's revolutionary sort of being accepted. And that's how I think about it. So if you're introducing a revolutionary idea, white label tech. And if you're actually just improving a system and concept that already is out there, build your tech. That's it. And because you just can't, you know, what I learned at BlackRock, that on some level, you know, excellence is not exceeding expectations. It's just meeting expectations. If I am going to a restaurant with friends and we RSVP for 5 people and 6 people show up, we got to get a new place setting and possibly a bigger seat. We might have to wait longer for the restaurant. If we had a table for 4 or for 5 and we had 4 people come, then now I told everybody they're going to pay $30 and not to pay more because it's a prefixed. And so really what would be excellent is if you just simply do what you say you're going to do. And if you, and the question on an investment side is, okay, if I'm going to buy your product and I'm planning on using your product to do something, as long as it does exactly what it does, I can handle what else is coming next. But if your product doesn't do what it's supposed to do by giving me too many or not enough, then now not only do I have to handle this, but I now don't know what's coming, and I might have to bring another person in. I might have to change my timeline. I might have to change my investor expectations or my client expectations. But whatever it is, it's uncertainty. It's risk. So excellence is not exceeding expectations. It's not like not meeting expectations. It's simply doing what I said I'm going to do. And when we take the word excellent out and we say, you know what's great? Just keep your word. Like people don't say super keep your word. There's no such thing as super keeping your word, right? And
I love it.
I get that we're talking about white labeling versus not white labeling, but at the end of the day, the only reason you'd white label is because you actually have customers and clients that are ready to go and they want something, or you have an idea that you effectively want to get to market and you don't have a way to bring it to market by building out your tech, or you do have the money, but you're not ready to growth and scale it. So don't. Use someone else's tech, use someone else's product and framework that already works, so you can work on this one variable. But in that sense, it's a game of risk, right? White labeling hedges risk.
Question on that. Since we're talking about risk now,
yeah.
What about, you know, now we can start getting into the supply chain. I mean, from my background, I'm more into application security and software supply chain, but now dealing with that vendor, that's a supply chain in itself. So the wrong white label vendor, right? From a support perspective, from, you know, just their security or their infrastructure can now put you at risk. What are your thoughts around that?
That's true. I like, yeah, okay. So
just like vetting, obviously, and things like that.
I mean, listen, I mean, there are business risks every time you have an interface, right? So if it's all in house, you have more control, right? But if you're bringing in, introducing a new concept, and then you're also building new tech, like that's a lot of risk. So the risk of your team building new tech that needs to be tested and needs to work versus bringing a white label solution and that already works, then like you're swapping out risk. But at the end of the day, it's always risk. But that you're talking about risk, and you're looking at the components of the business and understand where the risk sits. The risk sits in the joint of tying in your system with a white labeled solution. Like that's super clear. But that risk is very different than it's just basically hire a person to watch this joint, make sure your APIs are right. Is the user interface correct? Have you communicated the expectation to your clients correctly? And have you tested it out? And if you've done those things, then you've already mitigated your risk. And it certainly takes less time than building out a whole new software solution. Now, listen, we're not talking about, you know, what I would consider to be like a core innovation. So if I'm an investor looking at your business and you tell me you white labeled your tech, I'm like, okay, great. So if you've white labeled your tech, then you're not a tech company. You're just a company that's tech enabled. So let's talk about your core innovation, right? And now we're not talking white label anymore. We're just talking about core innovation. If your core innovation is XYZ, then okay, fine. Even that's great. But how are you protecting your core innovation by bringing that in-house? Because if you don't have that in-house, you've got no business. Or if you do, but you might have a franchise. You might actually just simply be a reseller of somebody else, which is okay, but just you have to understand who you are. And understanding who you are might, you know, listen, like there's 6 ways to make money: buy low, sell high, resell someone else's services, asymmetry of information, make it from scratch, compile things together so that effectively they're components, build them, and then effectively in building them. There's lots of different ways, but it's not new. It's been around for ages.
No, this is a great convo, folks. I mean, I'm actually going to watch this video again. I like some of the excellence analogy. Totally great. I loved it. What I want to talk about is the core innovation that you just touched on, though. So now, in terms of IP, so when you exit the company, if you sold it, now is that going to impact the value of the company because it's not totally end-to-end yours, you're dependent on this white label solution? Does that have any impact on valuations?
Yeah, so this is one of those ones where I'm going to say, you know, go to Dr. Google. But for those of you that don't know, what you ask for is, you might Google, like, what's the exit multiple for your industry, right? And then, of course, the question is, like, is it a marketplace? Are you a reseller? Is it a digital? Do you hold your customers? So if you understand your business, at the end of the day, when someone's looking to buy your company, they have to be thinking about how much more money can I make with my business, right? And if I make more money with my business because I bought your business, how am I doing that? Am I just taking your customers, scrapping your company altogether, and then bringing your customers to my platform? I bought customers, I've increased my top line. My operational expenses remain the same, and that might mean that me, as a buyer of your business, I'm actually going to be valuing your business differently than the person next to them who doesn't have a business at all, who just simply wants to buy the business and operate it themselves and deploy potentially new technology, because you're analog, you need to be digital. And so it as much as it is a benchmark of okay, so the demand. I'll just re-answer it differently. Okay.
That's all good. Let's go for it.
There's lots of ways to value a business, right? One is you look at the multiple of sales, right? 2, you look at market comps. So it means how many other companies out there in the market have sold, and whatever theirs sells for, you can say mine's worth that too if you find the right buyer. Demand, if you have 16 people that want to buy your company, you can bid it up. and liquidation value. If the company has no more money and you have to sell everything else in the company, what's that worth? Those are the ways you value companies, period. Okay. Yes, there are exit multiples to identify what the comps are. You can say, what's the exit multiples of my business? And that'll show you the comps. You can look at how many companies like mine have been sold in the past year. What do they sell for? That's my company's value. So when you think about that from valuation of the business, you understand the business you're in. And if you're a tech-enabled company, or if you're a tech company, understanding your core innovation will help you understand the type of company you are, so you can get a better idea of the comps.
Nice.
2 real estate companies, right? One is a tech-enabled company, one's a tech company. So again, demand, liquidation value, market comps, and a multiple of sales. But if you're looking at a multiple of sales and you have the same number of sales, and one's a tech-enabled and the other is actually a true tech company, it means something different, right? The sales, if you do multiple of sales, fine, it's the same, 10x sales maybe. But when you, I left this. Okay, thank you. I left the pan on. Sorry, my partner realized.
I love it, working from home. So we're all doing it, man.
So anyways, like, I don't want to repeat myself, but yeah. The point is, if you don't understand your business, you probably shouldn't be the CEO. If you are the founder and your business is evolved because the idea is evolved, you might want to just simply move yourself to head of product, bring in a CEO who's thinking differently, or find a partner who's thinking about the growth of your business who can think slightly differently than you can. Or just pitch your business to a VC, and the VC will politely and respectfully tell you you're wrong. Take your pick. That's the cheapest way to do it.
No, I love it. I mean, look, the insight. I like your insight. Like you said, this is something you just can't. You're not going to get on Google right there. So your insight is definitely value. I know that. I want to be respectful of your time. I know that we went on. Before 2 more things.
Yeah.
Additional items you want to cover in terms of pros and cons, and then afterwards, I want you to describe Stone Digital, your company, to the audience and stuff like that.
Yeah, I mean, so pros and cons of white labeling. I'll just tell you what. Like, there's the idea of the 80s and 90s about if you build it, they will come. Is true when it comes to probably real estate, maybe, but outside of that, if you build it, they won't come. So you can raise a bunch of money and you can build phenomenal tech and nobody uses it. And then 3 years or a year and a half, it's obsolete. And now you just wasted all that money. So in many cases, sometimes it's a function of as you're building out the product, really connecting with someone who's an expert marketer, who's really thinking about, is there a market for this? Where is the market for this? And how are we positioning ourselves as we build it? To deliver that to the market, and is this built in such a way that the use of it itself will grow its own user base? And if the answer is no, it might just make sense to just simply scrap it and literally find somebody else who has a business that's better, white label their product, and just simply make some money for yourself while you're thinking through ways to incrementally improve the product, right?
And I also want to add, because obviously we come where this is the tech behind FinTech, so I want to add the technology aspect. Sure. And I would say, and please, and I'm jumping on this, even white labeling or building from scratch, and a technology oversight is needed. It's still security implications. It's still ways on the integration. You can do things more efficiently, and looking at your software development lifecycle, looking at your APIs, and also securing that. So there's different points, and I just wanted to throw that into the conversation, whichever direction that you go. Now, can you tell us about Stone Digital? I want to definitely give you some time to do that. I want to learn more about it also.
Sure. So Stone Digital is a FinTech platform that focuses on providing liquidity or cash capital solutions for investors of and owners of real assets, performing real assets. So if I break that down, FinTech platform that provides cash for people who are looking for capital, or people that have ownership in properties and don't have the ability to actually have cash. So property rich, portfolio rich, cash poor, right? And we provide a number of solutions for that, whether it be debt, credit, equity, and investors a way out and exit, very similar to some of the other real estate platforms that you see out there. The difference is for us is that we're thinking about not just simply the real estate or the infrastructure from the perspective of like users, but rather the actual infrastructure itself. So typically there's an investment life cycle. There's a buy, there's a hold, and then there's a sell, right? And for a broker, a buy and a sell is the same thing. And for an operator, the hold is just simply the time frame. And then simply you might have an owner swap out, but the operator remains the same. What makes our innovation unique is that we focus on the asset itself, and the services that we provide stay with the asset. So if the owners might swap out over years or decades, and we'll stay with the asset and provide the financing and the treatment around that asset to ensure it's treated well, that it has a good relationship with the state, that the taxes are paid on time, and that all owners have adequate liquidity to ensure the property is conducted well. So imagine it's just a total completely different framework for thinking about a property. And because we're thinking about the property with a different framework, we cannot innovate anything else besides just simply the way of looking and a perspective around it. So we leverage several partners as we provide solutions to our clients throughout the investment life cycle of that product. And as the client goes away and a new owner comes into the building, we see them as a new client. We provide a similar service, but that provides continuity for the health and welfare of the building, which we think is an important aspect that's overlooked.
So I can just understand it more. I think my always ask a question. So
sure.
In terms of Stone Digital, you'll stay with that asset for the lifetime of the asset, and
until it's destroyed.
Till it's destroyed.
Yeah.
The only thing that may change during that life cycle, obviously, is the ownership levels, and that's being managed digitally through your platform.
That's correct.
Okay.
Right.
Got it.
And the tech evolves, the tech changes, and when that evolves and changes, just like Citizen Bank, we will evolve as well. We evolve our parish.
Where I used to actually work at TD Ameritrade, I always liked their saying "sink or swim." So I mean, so swim or sink, or however you say. So no, totally agree with you. No, that's very interesting, and definitely want to have you back on for future episodes, because there's a lot of things in your journey I'd like to unpack, especially as it relates to the technology behind it. Definitely interesting perspective. I would like to thank you for being a guest. I would like to also thank you for your insight. Definitely value for me. Like I said, some of these episodes I rewatch also, and I learn just like the audience. So I love the opportunity to be able to actually have dialogue with you about that. Yeah, definitely thank you. We're gonna go to the green room, and I just want to have a chat with you afterwards. I'm going to end it for the audience. If
I may say, just if anybody's interested in learning more about Stone Digital, or either looking for liquidity solutions, or wants to just simply exit early, or wants to just talk about what we talked about here, you can reach me on LinkedIn directly, or you can just go to stonedigital.com and then go to the info button and just reach me there as well.
And what we should do as part of this video, we're gonna put your contact information afterwards. I'll get that from you. We're gonna put it in the comments, especially on LinkedIn, so it can stay with the this post. So we'll put it in the description. We have your name in the description for sure, but we'll make sure we add some contact information to the comment side.
Super duper.
All right, so just hang out in the green room for me, and I'm going to end it. To everyone, once again, thank you very, very much for watching this show. If you happen to watch it in the future later, thank you for watching it in the future later as well. It's the power of the internet. All right, cheers.